recording. Okay, so we must be recording at this point. All right, let me see if I can get back to what I was doing before. And hopefully then I'll figure out if there's some way that I can see how to do this. Anyway, I'm not going to worry about it. All right, so the examination itself, there'll be 40 questions. They're worth a half point apiece. They take the same kind of general format as the questions that you have on your homework does. So they're mostly multiple choice, some true, false, and intermixed in there. On the first exam, what you'll be doing is a lot of stuff from chapter 2 and chapter 3. I think there are only 5 questions from chapter 4. And those are fairly straightforward as well. And we'll get into that in just a moment. But let's talk first of all about chapter 2. It's a little bit, it's more important than I think that for most of you who have never seen accounting in your lives, it's like a whole new language here. And basically that's what it is. It happens to be the language of business. And so, sorry? And so for starters, I think that what we need to do is we need to talk about what constitutes an economic event. So for instance, if I hire somebody and I haven't paid them yet, I just hired them. That's not an economic event, so I'm not going to be recording anything. There has to be an actual economic transaction that occurs. In other words, I billed somebody for services that I performed, or they billed me. I received some cash for something, or I received a promise to be paid later. Some sort of event that actually can be pinned down as an economic event. And so what we're going to do then is we're going to look at these events and try to figure out how to analyze them and how to put them into the basic accounting equation and make an entry for them. Now, if you look back on what we did for serial 3 part 1, that's where I went back and I did the economic events that occurred for SRA Business Solutions for the month of December, I believe it was. Now, the months of October and November, they were very similar as well. We had some trial balance information and other stuff that we got to from those transactions that we recorded and then posted to the ledger. And I showed the ledger as T accounts just simply so that you could see the left and right side activity that occurs in each one of them. So we have to have an economic event. It has to have a source document behind it. And source documents, bills from suppliers, sales receipts, checks, purchase orders, payroll records, those sorts of things give us economic events. We know that something has occurred, and then what we need to do is to actually apply it to the financial records. Now, we do that through a specific entry into the ledger, into the journal, I should say, that winds up going to the general ledger. And we do it through a series of accounts. Now, I'm going to stop for a second and talk about accounts because they're very significant here. If it's a 100 level account, that is, if it starts with a 1, those are assets. Those are always assets. And assets are equal to liabilities plus equity. So let's talk just about assets for a minute. Those accounts always start with a 1. So if you see a 1, you don't have to question whether or not it's an asset. You know it is. By the same token, if you see a 2 in front of an account, that indicates that it's a liability. A 3 indicates that it is going to be a basic equity account. When I say basic equity, I mean it's either going to be the capital account common stock. Sorry? common stock account, or it's one of those, or it's going to be a withdrawal account. Okay, so those are your 300 level accounts. And then beyond that, you have revenues, which are typically 400 level accounts. And then 5, 6, 7, 8, and 9 accounts. Those are all varying expenses, because when we get into the expense side, what we're trying to do is break those down as in a granular way so that we can track them better. We want to know exactly where we've spent our money, and we want to develop trends over time. And that's, by the way, the reason that we close out the accounts at the end of every period, so that we have, for instance, so that I know what happened this March versus last March and the March before that. And so the only way that I can get there is by closing the accounts on at each of those months. Now, at this point in time, all we're doing is closing them at the end of the year. But the reality is, in the real world, when you have any size company at all, we're going to do financial statements every month. And so that requires us to close the accounts every month. And we'll get into how we do that later on. Okay, so here's some asset accounts: cash, land, accounts receivable, notes receivable. Those on that are going kind of around like a clock. These tend to be the more current accounts. And then when you get over here, these are the long-term accounts: the equipment, the building, the land. Those are the long-term fixed asset accounts. Liability accounts, on the other hand, accounts payable and notes payable, the current portion of notes payable, unearned revenues, those are all current accounts. And then you can also get into long-term accounts, like the notes payable that is non-current. In other words, if you think about this for a second, you go down, you buy a new car, okay? And the new car is going to be paid off in 60 months or 72 months or something like that. And so you have really two portions that you have to be concerned with in accounting. The first portion is that amount that you're going to pay off within the next 12 months, okay? And then you have the other portion, which is the longer term portion, that portion that'll be paid off in months 13 through 72. That's the longer term portion. We split those apart. Okay, equity accounts. At this point in your young careers, you're seeing owner's capital and owner's withdrawing. And then you see these kind of sub accounts down here, the revenue and the expenses. Now, it's no mistake that revenues are pluses because they make owner's capital go up. So if you think about it, you're in business to do something. So the value of your business is going to go up as you sell things. And it'll go down as you pay out expenses. It'll also go down as the owner takes away withdrawals. So if they pay themselves, for example, or they give themselves dividends or whatever the case may be, anything that comes out of the company represents a withdrawal. So the basic accounting equation, assets is equal to liabilities plus equity. That will always be true after every single transaction that you do. And that's true forever. That one never changes. And
Mr.
so, yes.
I have a question.
Okay.
Because I saw before you started recording, you had the PowerPoint slides up, correct?
Yes.
Are you trying to make it so we can see the PowerPoint slides? Because all I see is your cam.
Oh, you can't see them?
Right.
Oh, all right.
I wanted to make sure, because I know you're recording this for other students.
Yeah, I was actually trying to share that. I thought I was sharing it. Okay, well, I don't know much about this Zoom. So can you see them now?
Yes, we can see them now.
Okay, so I apologize to everyone, but if you want to see what we talked about already, these are the PowerPoints that I provided you with from chapter 2. And we'll try to make sure that they're always up from this point forward. But the primary thing that you want to understand here is that this basic accounting equation, assets is equal to liabilities plus owner's equity, this will always be true, always. If it's not true, then there's an error. Somebody has made a mistake. And all new, that is modern accounting systems, they won't let you do it. They won't let you actually make an entry that is not reflective of assets is equal to liabilities plus owner's equity. Your asset, your debits and credits must be equal at all times, or they won't let you process the transaction. Okay, so what do I mean by debits and credits? Well, very simply, all I mean is if it's a debit, it's going to be an entry to the left side of an account. Doesn't mean good, doesn't mean bad, nothing like that. All it really means is that you have put an entry to that T account. And again, I would encourage you to look at the videos that I provided you with to see what I'm talking about. If I put something on the left side, then that's a debit. If I put something on the right side, it's a credit. Now, depending upon the type of account that is affected, so if it's an asset and is being posted to the left-hand side, that means it's going up. If it's a liability and it's being posted to the right-hand side, that means it's going up. An asset goes down on the right. A liability goes down on the left. So what I would like you to do, and I think maybe this slide here shows you this. This slide is incredibly important. So what you want to do is you want to make sure that you have internalized this. By that I mean you know it. Because when you get into examinations and so forth, you're going to have to appreciate, because I'll be moving very quickly through it, you'll have to appreciate what's happening here. Okay, so anytime, and notice, by the way, that this equal sign here, so assets are on the left-hand side of this equal sign. They go up on the left. They go down on the right. Liabilities are on the right-hand side of the equal sign. They go up on the right, down on the left. And the same thing is true for equity. It goes up on the right and down on the left. It's on the right-hand side of this equal sign. One of the things that you'll find out about accountants in general is that they are very, very logical. Everything that is done in accounting is quite logical. So, and this, by the way, I mean, we haven't changed the basic accounting equation since whatever, I think 1500. So, I mean, literally 1500. When a monk named Pacioli wrote a book called Summa Mathematique, and where he introduced basically the double entry system of accounting. And now, so if you look at equity in this particular slide, this is another important thing. If you notice here, there are 4 items in here: capital, withdrawals, revenue, and expenses. Now, 2 of those make owner's equity go up. Capital, revenue. 2 of them make it come down. If I take money out or withdraw money or property or anything else I take out of the business, the equity goes down. And the same thing is true when I spend money and have expenses going out. Okay? All right, so let me see if I can figure out, without screwing up the works here, how to get to the next chapter to talk about it. Okay, I'm assuming you can see that now, right?
We're still on double entry accounting.
You're okay. So let's see here. New share. Also, I have to change this every time. Weird. How about
There
now?
we go.
Ah, okay. All right. Well, we learn something every day.
Right.
Okay. So basically, let's start here with this accrual basis versus cash basis definitions. And we tend to work on, for most of us, we tend to work on the cash basis. What do I have? Well, I have some money. I'm going to spend the money, or I'm going to receive some money. And so that's this side here. Unfortunately, and that's the side we're most familiar with, but for us, we're going to work on what we call the accrual basis. And so we're not going to wait until we receive the cash to record an entry. Once we have substantially performed a service, okay, so for example, and you would see this in your real life, you realize if you think about it a little bit. You go out and somebody comes into your house and maybe they repair a refrigerator, okay? And so then they write you a bill, okay, because they've done the work. No cash is transferred yet. You're going to pay that bill later on. Same thing true when you have your electricity or your water bill or anything like that. Even the service has been rendered. You just haven't paid for it yet. So we still record it. That's the key. We're going to record it, and even though we haven't paid for it yet. And generally, we're going to record it as an accounts receivable. That is something that we're going to receive in the future. And by the way, anytime you see the word receivable, you're talking about an asset. Anytime you see the word payable, we're talking about a liability. And the good news about one of these recordings is you can always go back and write that down because it's pretty important stuff. Okay, and this one just goes on to show you, and by the way, all of these slides are available to you. They're all PowerPoints that you've been sent already. I'm just going through and kind of picking out some of the ones that I think are more important than others. In this case, and again, the serial problem, everything that we're going to do and everything that you can find on an examination will be on those serial problems. Every single thing. Because what they do is they go through and they try to make sure that every learning objective in that chapter is covered. So it may take a little while to go through them, but I don't even think it's that long. I think it's probably an hour and 15 minutes or an hour and 30 minutes to go through all three or four of the serial problems. So it's not like it's going to take a whole lot of time to go through it, but they'll give you a really good review of what you're going to be tested over, okay? So just bear in mind, and I don't need to go through this necessarily, if you have an expense on the accrual basis that is going to be recognized, then we have an expense that we know has happened. We just haven't been billed for it necessarily yet, okay? Or we haven't paid for it necessarily. But on the cash basis, it's different. On a cash basis, we would always have to have cash exchanged in order for us to make an entry. And again, this is what most of us use because we think about our bills on a cash basis. But businesses don't. They think about their bills on an accrual basis, okay? We recognize revenue when we've provided the service, or in the case of goods, if we've provided the goods, and we now have an amount that we expect to receive from our customer. Expenses, and now this one is, you notice this in parentheses here where it says the expense recognition or matching requires that expenses be recorded in the same accounting period as the revenues. So basically, think about this. Assets, what happened with assets is we convert assets ultimately to expenses. So I'm going to take some cash and I'm going to spend the cash on my wages for whoever works for me, or electricity or telephone or whatever the case may be. So I'm going to convert those to expenses. And the reason is so that I can generate more revenue. So what I want to do is, if I have revenue, I want to make sure that the expenses associated with that revenue are matched in the same period. So I always do matching, and it's a principle that we have in accounting. And so if we were having class, I would go more into detail with that. But since we're not in the traditional sense, you're going to have to, read the book and make sure you read all of these PowerPoints. Okay, so we're going to have 4 different types of adjustments. And so we have deferral of expense. That means we're going to pay the expense at a later point in time. We have deferral of revenue, which means that we're going to receive the money for the services that we've performed at a different period in time. We have accrued expenses and accrued revenues. Now, these are a little bit different. We're going to accrue those because we know that they've occurred, okay? And they may be received in the same period. And certainly they may be received in the same year. Let's just take a look at a couple of these. And by the way, I think that you would want to look very carefully at the, I can't remember whether it's serial 3 part 2 or serial 3 part 3. So you'll have to kind of take a look, but you want to make sure that you go through this, because this right here is probably 50% or better, maybe better, of your examination, these adjusting entries. So, and they're very important. Just make sure that you've gone through, find the one that deals with adjusting entries. They're always going to be the same. They're usually these 4 or 5 different things that we're going to talk about. And then those are the ones you'll be tested over as well. Okay, so prepaid expenses. Here's what happens. I prepay some insurance or some rent, and I pay for them in advance. Now, the reason I do that, by the way, is in the case of insurance, if I prepay my insurance, that is, if I pay for it for a period longer than the current period being, if I buy it in January and it expires in December, it's still prepaid in the sense that if I decide to change my insurance carrier 6 months in, I can do that and I'll receive a refund for the unused portion of that insurance. That's why we call it prepaid. The reason I prepay it is because it's cheaper. If you pay your insurance for a year versus 6 months, or certainly for a month, you're going to save, I don't know, anywhere from 15% to 25% on your insurance bill. So it's a good idea to prepay it, and that's why businesses do it as well. Sometimes businesses will prepay it up to 3 years. So, but that creates a problem for us because we're sitting here with an asset. Okay, so just as an example, I'm going to buy a 2-year insurance policy that costs me $2,400. Well, there are 24 months and 2 years. Okay, and so I put this $2,400 as an asset because I can get my money back if I don't use it. Okay, if I change policies or change insurance agents or whatever. So I put it in as an asset at $2,400. Now let's assume that 6 months has passed. If I look at the books, they're still showing $2,400, but I've used up 6 months of it, or $600. So what I have to do is I have to transfer out of the asset $600 by giving it a credit, and I have to debit an expense, that is in this case, insurance expense, for $600, so that I can transfer it from the asset to the expense with the idea that it's going to support some revenues, right? Okay, the same thing happens when we go to, let's see here. I don't want to do supplies right now. I wanted to do, may not have it on here. But if you do prepaid rent, would be the same thing, okay? If I don't have a lease and I'm just paying the rent by the month and I pay it in advance, then if I leave, then I get a refund for the unused portion of it. And you'd handle it the same way And the only difference being that the asset, instead of being prepaid insurance, would be prepaid rent. And instead of being insurance expense, when you recognize the portion that's been used up, it'll be rent expense. Talk about supplies here for a second. And supplies, again, if you can visualize being in an office and everybody's busy and they're all going to a supply room and they're getting some pens or some staples or paper to put in the copier or a toner to put in the copier. We're sitting there and we bought all these supplies and we put them in as an asset, but we haven't adjusted them down. So when we go at the end of the period and we count how many supplies we have left, there's going to be a big difference between this number here and this number here. So what we have to do is we have to be able to adjust this number to get it down to this number. So think about something that's even more stark. Maybe this number was 10,000, and maybe when we went and counted, we only had 1,000. So we have to have a $9,000 adjustment going to supplies expense and a credit to the supplies to reduce those. I don't know whether y'all are with me on that or not, but I know I'm moving very quickly here, but 40 minutes is not a long time, particularly when you're used to lecturing for an hour and 15 minutes three times a week.
Yeah.
So it's vastly different here. And that's one of the reasons I do those videos, to give you plenty of opportunity to go back and take a look and rewind and all of those sorts of things. Let's talk about depreciation. With depreciation, what you have is a recognition of the fact that as you use an asset, a plant asset, that is equipment or buildings or cars, and by the way, we never depreciate land. We do depreciate land improvements, but we never depreciate land itself. The idea is that you're not creating any more of it and it only appreciates in value. But contrast that with the parking lot. And if you, yeah, your meeting will end in 10 minutes. Okay. Yeah, they just automatically dropped you out. Okay, so, but contrast that with the parking lot. Many of you have been to the ABAC parking lot, and I think they've just finished resurfacing one or two of them. But they get old and they wear out. And the same thing is true with a car. You know, the more miles you put on a car, the more worn out it gets. The more hours you put on a tractor or a piece of equipment, the less efficient it gets, and so forth. So, and that's true for all of these fixed assets with the exception of land. So what we do is we're going to try to allocate the cost of that equipment or whatever over the expected life of it. Now, these are estimates, okay? We're going to estimate what the expected life of the building is, but we know that for the most part, most places use 20 years in which to depreciate a building. We don't want to depreciate it forever. If we have a car, we might use 5 years for the car. We used to use 3, but I think cars are becoming, because of the way they're produced, they are becoming more and more, they have useful lives that are longer. Okay, so here's what we're going to do. We're going to take the asset cost, okay? And let's just, for argument's sake, let's say that that's $120,000. We're going to buy a building at $120,000. We're going to estimate what the building will be worth at the end of its useful life. In this case, we're going to say 20 years. And let's just say that it's 20,000. Okay? So 120,000 minus 20,000 is 100,000. And if we have a useful life of 20 years, when we make that division, we'll get 5,000. Okay? And that's what we're going to take for depreciation every year. Now, where it gets tricky for you all is that we're going to very rarely use a whole year. We're going to use some months, 3 months or 4 months or whatever. So now you have to take that and apply it to, for this period, how long you've had it. So I'm going to give you an example. Let's say that you buy something on September the 1st. This same building that we just talked about. So we put it in there and we get $5,000 a year. However, we bought it on September the 1st. So we only have 4 months with which to deal. So September, October, November, and December. All right. And so what we're going to do then is we're going to look at 4/12 or 1/3 and multiply that 5,000 by 1/3 to get to the current year's depreciation. Okay. So whether that's 1667 or whatever it is. Anyway, that's the way that we will get to the depreciation. And most of the time when you have these in accounting problems, we're going to give it to you in a way that is with typically with no sense. So in this case, let's say that we would use 3 months. So it would be October the 1st, and then we get 1250 as a depreciable value. So you're only going to depreciate the amount of time that you've owned the asset or had it in service. Okay. Useful life, that's just an estimate. Salvage values, that's an estimate. So most of the stuff is built on estimates. Now we're going to be very scientific about it. We're going to look to see what similar assets have, what kind of value similar assets have held, and so forth before we do it. To make the adjustment now, this is where it gets critical for you. And you can read all of this as you go through, but what I want to point you to is how you deal with the adjustment itself. So in this case, we had $300 worth of depreciation expense for 1 month apparently. And notice that we're going to debit depreciation expense, an entry to the left side of the expense, which makes the expense go up and equity come down. And we're going to credit this to accumulated depreciation. That's a contra asset. All right, it's not an asset, it's a contra asset. Contra means it goes against the asset. Okay, and so typically what you're going to see on your examination is you'll have to make this calculation and then tell me where it goes. And then also make sure that you're looking at your dates. Okay, because dates are critical here. We're always going to have in these accounting exams, they're always going to be partial years that you have to deal with. Okay, so I'm afraid I'm just going to have to move on from there. But again, you have all of these, but the key here, you're going to have about 60%, I'm guessing, because I looked at it yesterday when I put it together, when it was all said and done, about 60% of that examination is over chapter 3. I know that there were only 5 questions over chapter 4. And so very quickly here, I'm going to go over chapter 4 and just tell you what you're going to need to close. If you look at your trial balance, everything from withdrawals on down, and because we put them in number order, they're going to be in that order. Everything from withdrawals down through the rest of the expenses, those all get closed. Those are all temporary accounts. Everything from capital up will stay there. All of the accounts that you have that are real accounts, the assets and liabilities, every single one of those is simply going to move over from the adjusted column to the ending or post-closing trial balance column. The only thing that's going to change is going to be your capital. That's the only thing that's going to change. Revenues will all go away. They won't be there. We're going to close every single one of them out. Revenues have a normal credit balance. We're going to debit them, okay, and make them go away and put it to income summary. And again, if you look at the This is serial 4. It's a very short one, about 15 minutes, and it walks you through exactly what you have to do in the order that you have to do it in. You're going to close the revenue to income summary. You're going to close all the expenses, and expenses have normal debit, so you have to credit them. And you're going to debit income summary. And then you're going to get rid of the income summary. You're going to put it directly to capital. If you need a debit to get rid of income summary, that means that your revenues exceeded your expenses. And therefore, to get rid of income summary, you need a debit. So the credit is going to capital. That's net income. If you need a credit to income summary, that means your expenses were higher than your revenues. If you need a credit going to income summary to close it out, that means you're going to debit capital. Remember, equity goes up on the right and down on the left. So if I'm debiting the equity to capital, then that means that I'm losing equity. And I know this is a lot to absorb in a very short period of time. Lastly, we're going to close out the withdrawal account. And we'll do that by crediting it and debiting the capital. And that'll always be the case because you're taking stuff out of the business. So when you take it out, you're going to debit it. So to get rid of the account, you're going to credit it. What you're left with, it will be the new capital. And again, if you look at serial 3, part 3, I walk you through how you get to that new capital. And when you're all said and done in your post-closing trial balance, the only thing that really has changed here is you have no more temporary accounts, and the capital account reflects the new number that we have generated. So I know that's fast. I know we went through it 100 miles an hour. Just remember that you probably got, I'm saying at least 60% in chapter 3. So if you have a limited amount of time and you want to focus your efforts, make sure you're focused on chapter 3, because that chapter alone will determine whether or not you do well or do poorly on the examination. Are there any quick questions?